Hello, and welcome to The Responsibility of Investing, the PRI's podcast. My name is Nathan Fabian, and I'm the PRI's Chief Sustainable Systems Officer. Today, we'll discuss the impact of rising economic inequality for investors. And for that discussion, I'm joined by Delaney Greig, who is Director of Investor Stewardship at the University Pension Plan of Ontario, and also Emma Douglas, who's Sustainable Investment and Stewardship Lead at Brightwell, which manages the assets of the BT Pension Scheme. And of course, many of you will know David Wood, who is Adjunct Lecturer in Public Policy at the Harvard Kennedy School. So first, some context. 10 years on from the adoption of the Sustainable Development Goals, economic inequality is rising and many say reaching critical levels. We know the SDGs are off track, and this includes Goal 10 to reduce inequality within and among countries. We also know that 1% of us own over 95% of humanity's wealth and 43% of all global financial assets. And in several countries, including the US, the proportion of income received by the top earners has returned to levels not seen since before the Great Depression. So as you might expect, this is motivating a response from many stakeholders in our global system. UN member states committed to a new agreement called the Doha Political Declaration, very recent, to respond to demographic shifts and focus on things like job creation and living wages. And even the G20 believes that it's important to monitor this growing global inequality to support policymaking. And many of you, including the PRI, will be closely watching the Task Force on Inequality and Social-Related Financial Disclosures because we all know we need better metrics. So as managers of the savings and financial livelihoods of hundreds of millions of the world's citizens, these seem like very important topics for us as a responsible investment community to discuss. So Delaney, can I start with you, please? Do you consider rising economic inequality within developed countries to be a material risk for long-term investors? And if so, how do you see it?
Thank you, Nathan. So yes, obviously we do. Just before I get into that, though, at the human level, it's gross. It's obscene, right? Like the degree of gap between the haves and the have-nots. So there's this instinctive moral concern, but that aside, we're a pension fiduciary. We have to make decisions based on the best long-term interests of the pension plan. For UPP, that also means, and it's spelled out in our statement of investment beliefs, looking at the health of capital markets and the systems on which they rely, including environmental and social systems. So we've identified inequality as one of those systems that puts our portfolio at risk and the rise of inequality. So we've outlined arguments in our stewardship plan around the implications of this rising inequality for economic growth, for volatility, for the erosion of the demographic base, and implications for political instability. So there's these various aspects in which, because we're a highly diversified pension plan, it's going to impact our long-run success because we're dependent on the success of the economy. And when you have an unproductive distribution of resources in the economy and it's concentrated in certain pockets and not available at all for others to use, then that is a problem for a pension like ours. And then I would just add that when we get down to the company or entity specific level, there's also concerns with inequality because there's evidence to show, copious research, that high performing individuals in organizations with high levels of inequality in pay and authority, et cetera, perform worse than they would if they were in a more equal organization. So we see it both as a risk at the societal level and at the company level as well.
Yeah, so thank you, Delaney, for calling out these two dimensions, which are both essential dimensions of a long-term asset owner's role. And we'll explore how you respond to those a bit more in the discussion. Emma, how do you think about it? Any differences? And if you can, give us your own fiduciary angle on it.
Yeah, sure. Thank you. I think Delaney has covered it and introduced it really well. I guess there's some similar aspects. So, we very much believe inequality is a systemic, non-diversifiable risk that will be capable of disrupting economies, lowering productivity, increasing that geopolitical and reputational volatility. We're already seeing it. So there is rising inequality, it's undermining economic growth potential, there's political instability, the growth of populist movements, particularly in the EU countries. In the UK, we're seeing policy shifts with governments responding to this. We're going to have higher taxes. There'll be potential for stricter regulation in this area. There are economic consequences, whether it's kind of overall weakening of resilience. That's a key area we're focusing on going forwards, because persistent inequality has the potential to harm the stability and predictability on which our long-term investments depend. So we could see higher costs of capital due to the elevated perception of risk, and that in turn drives investors to demand higher returns. But I guess an additional point is that it's not all about the risk side. There are opportunities as well. There is that long-term value creation aspect where if we seek and are able to address some areas of inequality, we could reduce exposure to those systemic disruptions with greater productivity, innovation, sustainable growth, and ultimately more stable societies. I was reading an interesting statistic a while ago that there was an OECD study citing that greater gender equality in labour markets could raise GDP by over 17% in OECD countries by 2060. I mean, that just shows there are opportunities, and we really need to address some of these issues, but also understand where the most material risks are.
Yeah. Thanks, Emma. And again, both company and system or societal reflections on the investment thesis, which is very good to hear. And so, David, we've had already two quite thoughtful openings. You're a long-term, well-known expert in this area, and hopefully you can help our audience. Just take us through some of the research on the level and symptoms and drivers, if you like, of inequality, and what we can expect for our economies as a result.
Yeah, sure. And I'm not like a researcher of inequality. I read the research about inequality and think about how it affects responsible investment. So I don't want to lay claim that I'm a consumer of the research, but I'm fascinated to hear Delaney and Emma how much of the research has been integrated into investment strategy. Like when we started our project with PRI, those responses couldn't have happened. So I think that is some kind of progress. Although obviously inequality is still a super big challenge. The big change in the research on inequality, and it came out of, in particular, work out of the IMF and the OECD, just overturned the conventional belief that inequality was the price of growth. In the past, people thought inequality was an engine that increased competitiveness and therefore floated all boats over time. Later research suggests that inequality was actually a constraint on growth. And growing inequality put pressure on economies that made them less productive and less resilient. And therefore, investors, had to be concerned, because if they do depend on the economic performance systemically, they need to think about systemic issues, as Delaney and Emma have pointed out. I do want to say a little bit about the kind of way that inequality came into, at least my world, with responsible investment. The board member at the time at PRI was Priya Mather from CalPERS, and she had a narrow interest of, we want to increase attention to social issues, which was one of my interests too, working with the pension trustees, especially associated with the labor movement globally. Inequality had become the kind of top of the paradigmatic topic for the S in ESG in the way that climate had for the E. But that was because of the global financial crisis, and that was because of kind of the social reaction to the costs of inequality that were manifest in financial instability. And it took that kind of change in public attitude, as well as the change in the research, to come together and make this something that responsible investors have to think about. So that's kind of the way, that's a little bit of background in the topic generally for investors. I don't know, Nathan, how deep we want to go into the kind of drivers of inequality.
It's interesting to know some of the drivers, I think, because we're going to hear again from Delaney and Emma about how they act as investors, and I think what they do. And I think that's quite interesting when you're thinking about system and company level dynamics. So do just give us a quick sense of the drivers.
It's such a complicated topic, and there's, it's not something that's reducible to X leads to Y. There's huge structural changes. The move from rural to urban societies is the major sort of thing that inequality research in the past looked at. The change from agriculture to manufacturing, changes in technology, more recently a swift from manufacturing to services. All of these have huge implications for how wealth is distributed. But I think more to the point for here, we also see socially and policy-driven outcomes for inequality that are sort of implicate investors, but also are things that investors have to be concerned about. We've seen rewards concentrated through increased financialization. We've seen reduced taxation leading to income and wealth disparities growing. There's been a concentration of market power in certain sectors. There's been reduced labor power in many places. There's been the fraying public provision of goods and services. Like, all of these are immediate drivers of inequality, and there's systemic challenges that I think investors can think about. It's not like this is new. John Kenneth Galbraith in the 1950s was talking about private affluence and public squalor. But in the meantime, the share of wealth in the United States has, pretty much doubled at the top, 1% since he wrote that. So this problem is a long-standing one. The drivers are complicated, but it's been increasing, and you can see there's a big delineation in 1980 where you see it go up.
Yeah, right. So that the evidence and the data is actually quite clear. Sometimes the refrain is, oh, we don't have the data, we don't have the metrics, and it's harder on social. But really, you're saying the opposite. You're saying we've understood this for quite some time, and there's a clear indication in the data of growing inequality. And not only that, we know it hampers growth, and we know it hampers productivity, as Emma, I think, said quite well. So the relevance to portfolio investors is squarely in their wheelhouse as part of their investment considerations. I think the data is actually quite clear. So that's very important baseline. Thank you. So Emma, let's come back to you. What do you do to respond when you can see the impact on your obligations that you're managing for beneficiaries? How do you respond to it?
Yeah, I think just picking up on that point around the data, I completely agree. There is data out there. There's plenty of data. And now we've got AI. We need to really develop on that, creating practical tools and embracing the qualitative data that we have. So not just reducing everything to these quantitative metrics. They have their place and they are useful, and we will use them, but also acknowledging the value that you can get from a lot of this qualitative information. So what we've done is we've taken a strong stewardship angle when looking at social issues. And over the past year, I've been collaborating with a sustainability tech firm called Cambry. And that's all about creating this tool to understand, identify, and prioritize social factors across both public and private portfolios. And through this analysis, we've been able to identify what are key sectors, key asset classes, portfolios, and also social issues to prioritize them then for engagement.
Okay, and so that granular asset classes and sectors piece is quite interesting. Can you just tell us a couple that are important to you? Or Delaney, would you mind giving your perspective on that same question?
Yeah, so firstly, it is based off of, to those who might be familiar, Shift's business model red flags, because we think they're really credible in this space. It maps how different business models may exacerbate social harm or inequality. So we look at 44 different sectors against a range of social factors. So it's very much at the sectoral rather than the company level. And then we can see where the high risks are. So there are some really interesting initial results. It shows previously underexplored areas as well. So one example, for instance, is the internet and media services sector. You can imagine the different social risks that might crop up there. But what it highlighted to me was that actually there are social implications of what are very widely held tech and media companies across all of our portfolios, but they're often underrepresented in those traditional ESG frameworks, because on traditional metrics, they just won't flag as being really material. Particularly if you're integrating more of a climate approach, they won't be as material. Or another prominent insight was the exposure to depleting natural resources or public goods that then undermine access and health. So an example there would be an industrial activity like manufacturing or the extractive industries that then leads to pollution of the environment, which in turn could harm human health. And I think that's an interesting example because of the interconnectedness between, climate, nature, and social risks.
Yeah, we're building reinforcing relationships between these factors that widen inequality, give us much weaker basis on which to address them. It's a really important insight. Thank you. Delaney, what are you thinking about the important cases?
We've taken a slightly different tact or approach to this issue. And I think, like, from David's setup, when I first brought forward this idea of focusing on inequality at UPP, our lead of risk was like, yes, of course, I've been tracking the Gini coefficient for decades, right? So, like, there's an understanding of why this is a problem. It's the making it actionable that is difficult, I think, for many investors. What you need to do is to break that down. And like Emma's outlined how they've gone about breaking it down to understand sector by sector. We took a slightly different approach. So we did do some mapping to understand the intersections of the factors with our portfolio, risks, opportunities, impacts, dependencies, and then looking at some of the work that David has done, that there's work coming out of Rights Collab of the Investment Integration Project. I'm just going to put out some of the resources. Investment Integration Project, the Pre-Distribution Initiative, Shift as well, the PRI's work, and then now TISFD, the Task Force on Inequality and Social-Related Financial Disclosures. So there's this body of work that you can kind of start to map, again, these drivers of inequality. So we took, rather than going sector by sector, we took what are the drivers that are most common across all sectors, and where do we have within our toolbox of responsible investing tools, do we have tools that we can use to action that? And of course, needing to be humble that we're not going to change this, but we can be a piece in that puzzle towards shifting it. So where we came to is to build top end and bottom end guardrails. So we're at the top end, we're looking at executive compensation and excessive pay as where we're starting to see, as David was outlining, this financialization and more concentration of compensation. Inequality is about the gap as much as it is about the conditions for those at the bottom end. And so that's why we decided to take and put in our proxy voting guidelines a metric around executive compensation above which we will scrutinize very carefully and are predisposed to vote against. And then at the bottom end, we're looking at fundamental labor rights, the rights the ILO has set. If you're working, you should be paid, and you should be paid fairly. You shouldn't have to be in physical and psychological harm while you're working. You should be able to work with your colleagues to improve your conditions of work. You shouldn't be discriminated against because of your race or gender. So these are very basic principles that, unfortunately, we still need to push forward today, but have been agreed to by governments, corporations, and workers. And so we are seeing as these two buffers as where we're pushing forward to start to squeeze in, I guess, on inequality from the top and bottom end.
So it's very interesting the way you recognize your role in the system. You've got such a coherent argument on the rational benefits if the inequality is reduced. The prudence and loyalty dimension of your action is actually quite so clear. And then you've identified, well, we recognize we're an actor in a system, so there's certain things we can do and expect and work towards as an actor in the system. Do you feel that there's an obligation to demonstrate the impact of your guardrails, for example, on the outcome? Like, how far do you have to go down that path to reassure yourself?
Yeah. In some ways, there is, because otherwise, why are we doing this work? But I think we need to think more carefully about what the outcome is, right? Because this is an issue that we're just grappling with it and trying to figure out how to make it actionable. So I consider a win right now if at this point, other investors are starting to question whether they should have some guidelines in their executive compensation. I don't expect companies are going to change the way they compensate executives, but we got to say unpaid vote. So we need to use it in a way that fits with our long-term fiduciary duties across the portfolio. And the same with the labor rights. Like, we're a part of the Labor Rights Investor Network. which is a group of investors trying to understand these issues better. So I see that the ability of investors to start taking action on freedom of association issues as a huge shift that we can consider at this stage a win, and whether that's definitely not the end, but it's an outcome to start.
Yeah, okay. But once again, you're making such a coherent argument for how it's in your rational interest of your beneficiaries to try and build common action on these problems so that the costs can be internalized and addressed. So it's very, very clear. Thank you. Emma, anything to add on this? And I guess I'm curious, if we go down to the more of the company level, is there something you would add?
Maybe more of a concern I have, actually. So I think Delaney makes fantastic points, and I don't disagree with anything. It's just, how do we communicate and translate that to our beneficiaries, our trustees, and those in the industry who perhaps are less familiar with all of this stuff? My biggest fear is that we go down a similar route to climate, where we have this polarization, we end up with a backlash. Certainly don't have any of the answers, but I just want to pose the question of, how do we ensure that going forwards we don't make inequality the next kind of controversial area or topic for investors? How do we kind of keep that in mind when we're taking action and doing all the good stuff we're trying to do?
Yeah, well, maybe David can help us out on that. We're going to ask some other questions in a moment, but this is quite a thoughtful reflection. What's your view?
Yeah, I don't think I'm going to fix that one. I mean, I think Emma's right. This is to the extent that investor interests are going to, investor demands increase, the threat of backlash is real. I just don't think it's avoidable, because necessarily, like, if you're going after a system that produces inequality, you're going after incumbent interests that will resist. One of the reasons we're concerned about inequality is that it opens up the door towards, wealth runs with power. Rent seeking is a bigger potential when there's concentrated wealth at the top. And so I think you'll get that resistance. And we've seen, like, resistance comes with backlash. But I mean, I do think, and I was very taken by Delaney's grounding of their approach, or I think, Emma, you've said the same thing. You can ground the approach in justifiable fiduciary concerns that are clear enough. And a concern with systemic issues is so necessary for a big investor that I think you're guarded against the kind of bad faith attacks that will be coming. Surely there will be good faith attacks, good faith discussion about what the right solutions are and how far investors can go. And I think it's not always clear what investors' role are in this. But I just hope we don't shy away from the topic because of backlash, because I think that's why we get it. Is to just shut down discussion, not to produce it.
Yeah, can I just add, I think there's a bit of, and I mentioned earlier being humble, and I think there's a bit of, we have to make sure it's not the pot calling the kettle black, right? Like, we know we are part of the financial industry. Financialization is a large part of how we've gotten into this problem. But at the same time, pensions, which are much of the assets in the financial sector, are the savings of middle-class people. And we need pensions to protect against worsening inequality. And so I think we need to understand our role within the system. And that's the tricky stuff, right? That we have to get through. But we can't just be saying that other actors have to change things. We need to adjust our mindsets as well so that we protect ourselves in the long run.
And of course, the pension system was set up with the future benefits in mind. That's why it exists. It's so fundamental to this idea of loyalty, I think, which is really very important. So, okay, we could go lots of different ways. I just wondered, on Emma's reflection quickly, if we kind of don't have transition risk in the same way we have on climate, because when you're doing a forward-looking assessment and thinking about transition, I wonder if that makes it a bit easier to criticize future loss as a premise for action. Whereas I think the argument or the discussion we're having here is actually the data and evidence about the impact of inequality is so clear today. It's affecting our portfolios today. It's affecting our returns today. And we really are flipping that argument that this is harder, I think, than some of the environmental factors. And I think this is, if there's one message that people take away from this, have a closer look at some of the data and the frameworks that our colleagues are using here to make judgments. And this is quite an advanced area of study and research. So let's have a think about now what governments are doing. And David, if we can come to you. Now, I guess there's some traditional ground here. So lay it out and then give us some of your insights about what's important for governments today and how investors should be working with them.
Sure. And I mean, there's just so much to do, and some of it's relevant to investors and some of it's just relevant to a better society. And I'm not sure that we need to sort that out too analytically. I should also say, in light of this research, the G20 just put out a great paper on inequality and really just captures like the depth of the research, but also offers a pretty clear set of potential interventions that you would think about at the government. And they're on the pre-distribution side and they're on the redistribution side. On the pre-distribution side, the kinds of things that Delaney's talking about with labor rights and sort of the empowerment of labor and the labor capital dimensions are clearly part of dealing with inequality. Labor density and inequality are inversely associated. And so thinking about labor rights is pretty important. I think given the research shows that there are foregone resource, uses that result from inequality, as people aren't able to do the amount that they can. They can't be as productive as they want. And also there's the instability question, like the resilience to shock question. So what can governments do about that? There's sort of access to education and services that allow people to enter the workforce at the place they want to. And there's just an enhanced safety net and public service provision to sort of put a buffer on instability. Those seem really important. But you can't get around taxation. Redistribution is the way that we've dealt with inequality in the past most effectively. And I think fair and transparent taxation, especially, I think one of the big changes in wealth inequality has been the globalization of financial services and tax avoidance. For investors, that undermines the public sphere that they depend on for a functioning economy. So thinking about the taxation system seems really important.
Yeah, so all right. I can hear some of our community's voice in my ear saying, now you're getting into the really political stuff, aren't you? And so how do we navigate that space? Delaney and Emma, is it fair to ask you how you think about, some of the buffers, the resilience buffers that David talked about are maybe not too controversial, but if we're getting into taxation, we are getting into politics. So how do you think about it?
So first, we deliberately didn't include tax in our first plan around inequality because it is such a muddy area, especially as an investor. But I know there are peers, I cite Lacaze in Quebec, I'm sure there's others as well, that do have policies around minimum tax expectations because they see the risk associated with a fund participating in tax avoidance, right? And it's a mitigation against that, and also just a value that government services provide. But what I think it makes, if we're going with the tax head on, where I see is just for pensions in particular, but and other investors as well, to just stay out of the conversation and let tax policy be made based on what makes the most sense for the country. We can participate in other conversations. UPP is active on climate and some of the real economy policy issues in Canada, and I think we could someday do the same. We've experimenting with climate. I think we could do the same with some social policy issues, but there's others where our best value is just to not push back against a policy shift. And then I would say that maybe the more low-hanging fruit, more tangible things is things like the human rights due diligence laws, modern slavery type rules that both give us a set of information as investors, but also help to build in some of that protection. And then also, and this is maybe a bit outside of government realm, but some of the standard setting that is looking to be done through the TISFD is part of that as well. In the same way we've done with climate and nature, is that it's a standard setting and the basis on which we can then make policy choices and build investment structures that avoid contributing to inequality.
Yeah. David, you want to come in on that?
I just want to distinguish. I think this is right. And one of the investors' role is to get out of the way of public policy discussions or not be used as a barrier to them. But tax transparency and sort of fair taxation systems is something investors really should speak up on, because the promotion of rent seeking and the expenditure of resources on tax avoidance strategies are resources that aren't put into the productive economy. And that to me seems like something investors, there's just no political reason not to do that. I definitely want the government setting, tax systems based on their own democratic principles. But I think investors should look at the global tax transparency schemes that are out there and pitch in.
Yeah, that's one of the areas I think that when we've had signatories interested in tax, that's the one that they all lean into. And Delaney, thanks for the subtle recognition, actually, that we do talk about taxation when it comes to carbon emissions. Pricing emissions has been a long time policy conversation for the investment community. But yes, this area of taxing labor and this theory distribution obviously does take more care. Emma, anything you can share about how you navigate it?
Oh, this is a tricky one. I think it's been well covered, to be honest. I don't think I can add too much extra. I think my overarching comment would be just that as asset owners, we just need to be doing more in this space generally around policy advocacy. Governments hear a lot from companies and corporates, and our voice does get drowned out often. So making sure the asset owner interests are being heard. I think collaboration is key. So we're having that consistent message across the industry. Obviously acknowledging that different asset owners will have very different investment beliefs and ways in which they manage the money.
Which is absolutely fair. And it's why transparency of lobbying activities between corporations, their associations and governments continues to be a critical and cross-cutting issue that, and I think the same goes here. It's definitely fair play for investors. Okay, so we're starting to come towards the end of our time together. And thank you for sharing, very thoughtful approaches and practical actions you're taking. I'm just thinking, if we look forward for Delaney and Emma, are there things that you want to work on next, or is there some call that you'd make to other colleagues who are listening to this discussion that you think are important to focus on as a key area for the future?
So I guess it's all back to that stewardship approach. For us, it's really focusing in on conversations with managers using insights we've gathered from our analysis to really inform those discussions. What our analysis shows is that there are certain areas we might think we need to focus on, but actually having those conversations with the fund managers and saying, is this reflective of the actual risks and opportunities we are running within the portfolios? And taking it from there, we've got a really helpful baseline from which we can start monitoring progress. I'm really excited for the TISFD to come out. I think that's going to be a game changer, and just keep, working on that to be aligned with developing expectations. How can we push managers to do more, assessing that materiality point, prioritizing where we think there are opportunities to really make a difference. We do have to acknowledge we can't do everything. There is so much to tackle just in the inequality space, let alone when you think about broader sustainability issues as well. So just continuing to address what are the key portfolio level risks.
Great. Delaney.
So we've been starting in the stewardship space, and I would like to see that translate into our investment integration space and where we are allocating capital. That is, I think it's more complicated, but I want to start thinking, and there are examples out there about funds in the US, for example, putting expectations around labor rights, some of the state pensions into their private equity mandates and things like this as a baseline that I think is interesting. And then there's also, I believe, opportunities around how we think about, for example, housing and what does investment in real estate really mean, and how can we have a steady flow of returns while contributing to affordable housing solutions. So I think there's some of that on the solution side and investment side. And then the other piece that I will say, just to echo what David pointed at, questions around competition and market concentration that we haven't fully grappled with. And I don't know what the actionable piece there is yet for us as an investor, but I think that is a big problem. It's a problem for investment opportunities as much as it is for growing inequality. So that side as well.
Thanks, Delaney. Also very thoughtful. Okay, so David, you've been in this game for a while. We've clearly taken big steps forward. But if you were thinking about where our community, responsible investment community, can go next, what would you be hoping for?
Yeah, I mean, again, I just wanted to say, just to have investors able to have this level of discussion about inequality as a topic is amazing. And I think that's a sign that social issues have entered the discussion in a different way in the PRI community and all this. That's great. I do think practically, it seems like inequality has more been layered into other approaches to responsible investment. So we've done a lot with PRI and elsewhere. Nick Robbins who's just left LSE on just transition, right? And sort of just transition became social issues being added on to climate. And I'm interested in sort of thinking about what it means to foreground a systemic challenge like inequality and where there are places. I think the Labor Rights Investor Network is a great place to go. I think TISFD, these things are happening, but where can investors pitch in more? I'm taken by the number of immediate either engagement opportunities. You can do misclassification as an inequality topic, and the research would drive particular engagements with particular companies on political risk. Housing is a great place to think right now about where there's investing in solutions that deal with the challenges inequality brings. Inequality is a great topic to think about when I'm not an investor, because it's so hard for investors to deal at this level of systemic challenge. And I do want to not kind of look away from how investors think about how they're embedded in society and how they relate to these broad social structures that produce things that cause economic and other kinds of challenges. I mean, Delaney started with just the fundamental problems. Inequality leads to vastly different health outcomes, educational outcomes that are bad in their own right. I think this is a good topic to at least bring investors to those discussions and to carve out what roles they can and can't play. And I'm glad that we can have that discussion. At the same time, we can think, here's some pretty straightforward things that we can do now to think about and address the topic.
Yeah, good, David. Thank you. Okay, now we're just about at the end. So we always have the same ending to our podcast, and hopefully you were brief. But if not, and I'm going to ask you anyway, because our podcast is called The Responsibility of Investing. And we always put a question to our panelists to hear what they think about this idea of responsibility. And so, David, I'm going to start with you because you're on a nice run there, I think. So the question is, what do you see as being the responsibility of investing today?
I mean, I think this field is interesting to me because it raises this question of how investors are embedded in society, how they're social actors. And I think when I think about the responsibility of investment, it means imagining what those embedded roles are, what obligations they bring. And then I talk to investors and I learn about the technical challenges of bringing those obligations to bear on financial conventions. To me, that kind of sums up the way I teach the field, but also what keeps me in it, even when I feel, I worry that we don't tackle those responsibilities enough.
Yeah. Okay. That's great. Thank you. Very clear. And lots of homework in that one. So Delaney, over to you. What do you see as being the responsibility of investing today?
So I think maybe I have two answers. The first one is a very simple, straightforward, and not probably meeting your question where it's meant to be. But as a pension, it's pretty clear what a responsibility is to provide for the long-term retirement security of our beneficiaries. Full stop. So that means stable long-term returns. But more broadly, I would look to something like the OECD guidelines, responsible business conduct, as a way to kind of some principles against which to ground yourself in order to be a responsible actor, to invest responsibly, and to think about, as David was saying, where you fit within the broader system and what the consequences, the implications of your choices of investments have. And that's maybe the call to action is to think about those consequences.
Yeah.
Both positive and negative.
Thank you. When you put it so clearly and you think about the alternative, not taking that approach, it seems like a big gap, doesn't it? Missing quite an important set of questions about how you perform your roles and your duty. Okay, so Emma, what about you?
So very similar to what Delaney was saying, from a pensions perspective, it's all about providing for our beneficiaries. We've got to try and get the best risk-adjusted returns. That is the primary fiduciary responsibility. And yet there is also, this other school of thought around we want to help our beneficiaries retire into a world worth living as well. So I think that angle will probably crop up more and more over the next few years, or if not decades, as we become more mindful of what's going on in the world.
Thank you, Emma. Thank you to all three of our guests today, to David, to Delaney, And of course, Emma, to you for that thoughtful response. And thank you to our listeners for joining us for this session. The PRI is committed to supporting our signatories to incorporate these inequality issues into their investment practice, and we look forward to sharing more with you in future. Thank you all for joining, and we'll see you next time.